The next thing I would buy is like DeFi or Bitcoin. Because the thing about
Mm.
stablecoins is they put you one jump away from the rest of crypto. Once you have stablecoins, your probability of using DeFi, I think, probably goes up 100 million fold. And so I would look at even some of the isolated, unloved DeFi protocols out there that are trading at really low valuations and find those attractive in a world where there are 100 million or a billion stablecoin users.
Another major insight from Hougan is the idea that Bitcoin is gradually losing its reputation as an ultra-risky investment. Historically, crypto markets were driven by speculation, hype cycles, and short-term retail traders. Prices moved violently because capital flowed in and out rapidly. But Hougan argues that the market structure is changing. Instead of hot money rotating aggressively between crypto sectors, the market is now being supported by a slow but steady stream of institutional capital. This institutional money behaves differently. It is longer term. It is less emotional. It tends to be more stable. It creates slower and less volatile market cycles. As a result, crypto may experience longer bull markets with reduced volatility compared to previous cycles. Hougan believes this institutionalization removes some of the chaos from crypto markets. While volatility will never disappear completely, Bitcoin is increasingly behaving like a recognized macro asset rather than a niche speculative token. That transition could be one of the biggest reasons why long-term investors continue gaining confidence in digital assets.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The only thing I'd add to that is just how much the Overton window has changed over the last year. I remember, for the first 6 years of Bitwise, we were like struggling to talk to people about a 1% allocation to Bitcoin. Remember the whole get off zero concept, 1% of your portfolio. If you lose it, you're only down 1%. That was like 6 years of repeating this story. And then Charles Schwab comes out with a video that says 2 to 7%, which 7% is above what Bitwise has historically said for most people, which is 1 to 5%. And that has just changed the conversation at these conferences that I go to. Like some combination of that and what Morgan Stanley is doing and what Wells Fargo is doing, Goldman Sachs is doing. Like it's been normalized so much that we've completely shifted from this maybe this crazy thing for 1% to why don't we put 5% of our portfolio in it and just shrugging our shoulders. It's really remarkable to me how much it's changed.
It makes it way less of a risk asset, doesn't it?
It completely does. And it completely is. Yeah. And it's just really remarkable. Like sometimes we forget it because we've been down in sort of the doldrums of the 60 to 80 channel. But it has really dramatically changed, right? It's become completely normalized, and we've just become almost inured to that. Which when I go out on the road, it just really strikes me how much more welcoming people are, and the size of the allocation that they're considering has really stuck with me. There have been so many big things. These two really caught my eye. There's this thing about stablecoins, which is they're $300 billion today. And everyone's like, they'll get to $3 trillion and we'll be using stablecoins instead of our Visa card. But no one ever explains how we go from degens trading with stablecoins to them, my grandmother using it instead of her Visa card, right? We don't talk about that bridge. And we had these two pieces of news that I think gave me a view. One was that DoorDash talked about paying its dashers via stablecoins on the Tempo blockchain, right? And the other was that Meta said it was going to start paying creators in 2 countries, eventually 160 countries, using USDC on Polygon and Solana. And what I love about these is it points out exactly how we get to the mainstream, which is we start with the edge cases. If you think about DoorDash's business, they have these employees that come and go over short periods of time in like 40 countries around the world where they have very tangential relationships with them. They're not onboarding them with a month-long onboarding process and paperwork the way we do when we hire someone. They're like gig workers, right? How do you pay a globally distributed group of gig workers in a quick way? Well, stablecoins make that push button easy. Same thing with content creators, right? Globally distributed. How do you pay them in a quick, easy button way? stablecoins are a nice solution. So of course, that's how it starts. But then you can imagine having millions of people who get used to stablecoins in this venue. And that's how we start to get into the mainstream. So I just, those are such big brands rolling these things out. And we used to have a few of these stories. We used to have Starlink sort of paying some people in stable coins. But now we're starting to see like multiple of these stories each week. And it just sort of painted a road that I could draw to the end point where stable coins are as normal as debit cards. And I really like those two stories.
Another interesting point Hougan makes is about the relationship between crypto and artificial intelligence. Many investors today debate whether AI or crypto represents the bigger opportunity. Hougan rejects the idea that investors must choose only one. He compares investing to enjoying a full dinner. It is perfectly reasonable to appreciate multiple opportunities at the same time. According to him, AI is reinventing intelligence. Robotics will reinvent labor. Crypto is reinventing money and finance. These are all massive industries independently. Hougan emphasizes that finance itself is one of the largest markets in the world. Therefore, the idea that crypto could become foundational financial infrastructure should not be underestimated simply because AI currently dominates headlines. His broader investment philosophy is diversification across transformative technologies rather than trying to predict which trend will outperform month to month.
Two things about that. First, you can like more than one thing at once. Like when you sit down to have dinner, it's okay to like the appetizer and the main and the dessert and have a nice glass of wine and some sparkling water and to love it all. That's all fine. Just because I'm excited about AI doesn't mean I'm any less excited about crypto. And then as any investor knows, these things go in seasons, right? This outperforms and then that outperforms and then the other thing outperforms. If you can time it, if you don't think you're late to buying SanDisk, then God bless you. Just do that. Just buy the specific thing that's going to go up the most tomorrow, and then tomorrow rotate to the next thing. But I'm not good enough to do that. So my approach is just to own all the awesome things and let those rising tides move at different time periods. I think the thing that we forget, because intelligence is such a big market and AI is such a big market, is that money really is a very large market too. Right? The little world that we're reinventing in crypto, which is money and finance, is one of the largest addressable markets in the world. And we're going to disrupt that in the same way that AI is disrupting sort of intelligence and robots will disrupt part of work. And again, it's totally fine to be excited about all of them. I do think it's taken some of the ebullience out of the crypto market, because the hot money, the hot ball of money that used to rotate into various parts of crypto is no longer rotating. What's lifting crypto is a slow drip of institutional money. That means I think we're going to have longer cycles. They're going to be slower moving, less volatile. So I don't think it's had no impact, but they can all eventually rise over time, which is I think what will happen. I think in some sense, it is that simple, right? They're going to use this, Circle benefits from it. We can sort of take the easy approach and just buy Circle. I think that's the next thing I would buy is like DeFi or Bitcoin. Because the thing about stablecoins is they put you one jump away from the rest of crypto. Once you have stablecoins, your probability of using DeFi, I think, probably goes up 100 million fold. And so I would look at even some of the isolated, unloved DeFi protocols out there that are trading at really low valuations and find those attractive in a world where there are 100 million or 1 billion stablecoin users. I don't know if Ryan has it. I mean, the other obvious answer is like buy Solana or buy Polygon, right? Those are direct beneficiaries. But I think you can go one step further into DeFi. Hey, you should buy some stable coins and then earn yield on them. And you're like, I'll just put it in the bank. But if you're getting paid stable coins and you're like, you can instantaneously earn yield on them, then all of a sudden you're in Morpho or you're in Aave or you're in a DeFi protocol, right? You're in a vault. So I think that's what I mean when I say like this is a huge push for the DeFi ecosystem. Is it just brings you so much closer to taking that step, and they're all going to be marketed to, and maybe even DeFi protocols will market through Meta to get to the people that it's paying. Like it's very easy to see how that ecosystem blows out from there. So That's how I would approach it as an investor if I had a long-term time horizon. Yep, I think that's right. That's well said. I do think we'll get through it either way, but it will be a short-term setback if it doesn't resolve positively. The other thing that would really help, which I haven't mentioned, is the DeFi hack thing chilling out for a little while. Be nice to have a stretch of solidity there, see Aave fully unlock and rebound. I think that would be very helpful to the community, and the reverse would be a significant setback. So that's another thing that's on my radar. I don't know, but I think the panic around Mythos and AI-based cyber hacking and the coincident timing of some of these hacks means we're taking them more aggressively than we would have otherwise. Like if we had one of these hacks, or even both of the major hacks a year ago, pre-Mythos, I think people would have been like, oh man, another one, that's brutal. But because they're happening in tandem, I think we're heightened. We're more concerned about it than we otherwise would. So maybe that's the third piece we need to really get this sustained rally. We need risk on assets to do okay. We need clarity, and we need not another series of major multi-$100 billion hacks.
Yeah, that would be helpful.
Despite his optimism, Hougan also acknowledges ongoing risks facing the crypto industry. One major concern is security and hacking. Large-scale DeFi hacks continue damaging confidence in the ecosystem. Hougan notes that the recent increase in concern around AI-enhanced cyber attacks has amplified fears about crypto security vulnerabilities. According to him, the market needs several things for a sustained rally: healthy macroeconomic conditions for risk assets, regulatory clarity, reduced frequency of major hacks. If massive security breaches continue, institutional confidence could weaken significantly. However, Hougan suggests that some recent panic may also be exaggerated due to heightened fears surrounding AI-powered hacking tools. Still, long-term trust in decentralized systems will require stronger security infrastructure.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.